The hottest address for hotels and retailers in Midtown Manhattan has traditionally been on Fifth Avenue, between 49th and 59th Streets. Now, one New York City developer is making a big bet that the world's well-known stores and hotels will drift south to a fresh stretch of Fifth Avenue. Sitt is the CEO of Thor Equities, and he joins us now. Nice to have you. And Joe, you know, kind of a dowdy area in some ways through the years. Having been a native New Yorker, I can say that. What gives you the confidence that that will change?
Well, we see the excitement in terms of the growth of tourism happening here in New York. If you walk the teeming streets of Times Square, Fifth Avenue, even Soho and lower parts of Manhattan, you see a dramatic increase in tourist traffic coming here. A lot of it is really being driven by the emerging markets. For the first time, you have people that, if you think of their timeline of emerging into the emerging market, that 5 years ago spent money on their first car, and then 3 years ago spent money on their first home. Now they're spending their first monies on traveling. And where do they want to travel? Those places they know from music and media, which is cities like New York, San Francisco, Chicago, Miami, London. And so that's translating into big traffic increases of tourism here in New York, and particularly markets like Fifth Avenue.
Now, coming by financing in this market to construct a new building is not the easiest of tasks. What gives you the confidence you can come up with what I believe is about $250 million that you're going to need?
Well, there's no question that we've seen a dramatic tightening in terms of the financial markets and availability of capital. You have CNBC markets that are not as liquid and not putting out the type of capital and leverage rates that they did. But you do have others coming to fill in the gap. There are capital-rich sources. One of them is Bank of China. Bank of China has dramatically increased the output of capital that they've put into real estate markets, and particularly here in New York. You know, it's like everything else out there, as I say, it's a world of haves and have-nots. In Europe, you know, you've got the downside of markets like the periphery, Greece, Portugal, Ireland, all scary. I personally think that Greece eventually leaves the EU and actually goes bust to some degree as a result that they'll force to. And then you've got the northern markets of Europe performing so well.
Let me bring you back to Fifth Avenue, if I may, because it's really interesting. I read from the Wall Street Journal that actually over the last 3 or 4 years, up at the kind of the Tiffany end, the Saks Fifth Avenue, their rents in 3 or 4 years have actually risen by 50%. So in fact, there's huge immobility, is there not, within Manhattan, because those prices, as you move down, say 10 streets, the rent halves and then it halves again another 10 streets below. You're way down that avenue. How do you get the mobility? How do you get these big names to move?
A lot is driven by traffic, folks. As I started saying, Northern Europe, they're traveling. Emerging market consumers are traveling. So with all that extra tourist increase and that density, more and more retailers want to have flagship stores and locations to cater to them. They don't want to be in the malls. The malls are suffering. The malls are being hurt. As I've said before, Best Buy, to me, today, a retail store is really a showroom for an Amazon to be able to sell them.
But in Manhattan, Joe, the choice is not necessarily between having a flagship store on Fifth Avenue versus having a flagship store in a mall. It's a prime stretch of Fifth Avenue versus perhaps Soho versus a Tribeca versus the various other neighborhoods that can command those sorts of respect from tourists who you're trying to cater towards. What makes you, just because they come, it doesn't mean that they will come to what you are building. So what is the driver to lower Fifth Avenue for you? The
driver is the tremendous increase in demand by retailers to now build flagship locations and only a certain amount of frontage. If you take Fifth Avenue and you pull out the clubs and you pull out the churches, the upper stretch of Fifth Avenue only has 2,000 feet of front. So if you're Zara, if you're H&M, if you're Uniqlo, if you're Tommy Bahama, and you want to be part of the New York experience, you're being forced to go further south.
Why do the likes of Tiffany and Saks stomach a 50% rise in their rents in a real tricky 3 or 4 year period? If that is the case, wouldn't they also move and go, well, we don't need to be here, we'll go down further down where everybody else is now going?
Well, you know, there's always levels, good, better, best, in terms of people's ability to do business and volume. So there's a customer that can't pay that rent at the higher part of the street, so they'll go to the lower part. If rents are $2,800 per square foot or $3,000 per square foot in the 50s, if I go in the 40s, I'm going to pay in the thousands. And so a business that can do that type of productivity can give the return to its investors. Also, you have to keep in mind, in terms of these overall staggering rental numbers, it's the productivity loop. When you do more and more business, you're not paying that much more in payroll, you're not paying that much more for lighting. So you can afford to pay a little bit more in terms of the rents and still net a greater efficiency to the bottom line of productivity and profitability.
What was the cap rate on the Takashimaya building when you bought that?
We actually purchased it vacant, but if you asked me if it was full, I would say the marketplace a year ago was probably trading somewhere in the 6s, which is still very low, and today would be somewhere south of 5%. So there's more and more, not just demand from consumers to shop those markets, there's more and more greater demand from investors globally to own those assets that they consider the bulletproof asset, that run to safety, that thing that'll give me a great hedge for inflation.
All right, Joe Sitt, thanks for joining us, and good luck. Appreciate it.
Thank you. Thank you.